let's start this off with some investment conversation. Troy, there's a clip that I sent, the last one. Can you play that one?
Me to be happy with a measly 12% on average return when I need to come up now. Look at these returns. If I was dumb and I invested in VTSAX, I get 12%. But look, if 10 years ago, I go all in on the real stuff that makes the world turn. All I do is I hold FANG plus Nvidia, Meta, Amazon, Apple, Netflix, Google, and Nvidia. I would have gone up 713%, 873%, 633%, 1,268%. JL, had I put my $3,000 into Nvidia, I would have gone up 26,209% in 10 years. So you're 12%. JL?
That's amazing. And if you had wings, you could fly. So what crystal ball did you have 10 years ago that told you that?
I
don't have one? Yeah, obviously, if you knew that was going to happen, if I knew that Bitcoin was going to go from a penny a coin to $100,000, I would have sold everything and gone into Bitcoin. The thing is, you don't know that's going to happen. And there's a lot of stocks that looked every bit as promising as those that you put up 10 years ago that flamed out and went to nothing. You would have wound up broke. You don't know which horse is going to win. But I do know that VTSAX will reliably make me wealthy. And 12% a year compounded over time, 8% a year. Let's be much more conservative. Compounded over time is an extraordinarily powerful thing.
Okay.
Powerful conversation.
They both have interesting perspectives, and they're both, and neither one is wrong. What's your thoughts on this?
Do both. All that you don't have a crystal ball, this is the price you pay for not listening to me non-humbly. Rolling out article. Shout out to Elwin for bringing this up. 10 years ago, I mentioned Nvidia and the companies to invest in at that time. Did I know it was going to go up 26,000%? No. Did I expect maybe 5,000 or 6,000? Possibly. They're both right. Like, people love to say that you don't know because they often hide. Like, the crystal ball is too valuable to even share with the public, even for certain prices. So I get that. But the answer is to do both. Invest in a conservative thing, which are indexes, and put your money into the emerging technologies and companies that are going to do well. And he's right. 10 years ago, you would have thought Intel would have done well. Dead. Pfizer, falling apart. There's a lot of companies in the tech space that are not doing as well. But the answer is always to do both. And to be very honest, listen to me. That's it. That's the whole. I was the AI before the algorithms and the open AI shit popped out. I was telling you guys which ones to invest in, which ones were going to fall apart way ahead of time. And it's not being talked about yet, but adding futures into that portfolio where you can get 3,000 to 5,000% in a year, I think is the ultimate blueprint. I mean, I think that'll get more popular over the next 4 or 5 years as well. But what do you think?
For sure. I think that, okay, from a perspective of, well, he said one key thing, the first guy, then he was like, if I invested in companies that's going to change the world or something like that, the most important company to the world. And like, even for me, like, you know, I always double check everything with AI. So like at the beginning of the year, I just go over my investment strategy. So I was like, okay, what companies, I do a whole thing. I'm like, okay, give me the top, what's the highest percentage, what companies have the highest percentage chance of increasing over the next 10 years. And I'm like, okay, now what companies have the highest risk within that? Which companies have the lowest risk in that?
And that's the most important question, to mitigate the risk for the companies that are doing bad in your portfolio and remove them out of the equation.
Yep. So it's like, okay, you know, it's like, okay, the obvious, the tech companies, right? The Nvidia, the TSMs of the world, the Microsoft, and then I'll say, okay, well, given a little bit more, like how do you feel about Bitcoin? Like, you know, I just kind of spar with it, and so it's like for me, that's why I'm like, okay, I'm invested in the Bitcoin space. I can't put everything in it just off of a risk reward ratio where it's like, shout out to Chris Johnson. He'll say put everything in it. And I respect that because that's worked so far. But I'm just saying for me personally.
At these levels, it's tough to do that.
For me personally. So it's like, okay, I got the exposure to Bitcoin. I'm going to have the exposure to Nvidia because I do believe that artificial intelligence is only going to get bigger. They're currently the leader in this space. So if that theory pans out, then they're gonna survive it. TSM, they're gonna be good as well. Okay, you have to factor in geopolitical aspect when it comes to China. That's their Achilles heel. So maybe you don't put your whole everything in there, but just keep that in mind. But then you look, okay, what's the safest bet? The safest bet is probably Microsoft. Then you start to look down the line and say, okay, well, where does gold come into play here? So you have your singular plays, and then you have your safety net with the index fund. And then for me, like I like QQQ because I feel like that's technically not an index fund, it's an ETF.
Yeah.
But
same thesis, but it gives you a little bit more growth on the upside.
Right. And if the theory holds correct, that technology will only advance even further and that the top tech companies will dominate the world, then even if you get one wrong on an individual side, QQQ is going to have all of them in there anyway.
Absolutely.
So you can't go wrong. And then it's like, okay, now you go from here individual to the ETF, and then you get the wider spectrum of the index fund. So, everybody's got their own theory. It's like, that's how I would play it, is like narrow, medium, wide. I look at it like lake, river, ocean. Yeah. Right. And then the ocean is the index fund, the S&P 500, because it's like, if all else fails, that's almost the entirety of the stock market. So you're going to be good with that. Right. So whether it's two tech, two index, ocean, river, was it river, lake, ocean? I'm
lake, river, ocean.
I'm coining this phrase, ladies and gentlemen. So I just came up with this. So if I see any influencer,
you're gonna see it tonight.
Please, but no,
like cenote pond.
But you got to do both. I think in 2025, you can't afford to just
begin it. You have to do both. The answer is never one. Okay, Rashad, should you do media and a concert style arena conference, or do one or another? It is both. All the hedges are dying, so the ultimate hedge ends up being doing a chimera, a combination of things. I didn't want to even have to get good immediately. We talked, and then Charlemagne and Joe, everybody even Sloss, he'll be like, okay, so you want to go back to running traditional ads, worrying about cost per click, cost per acquisition, or you can continue to build your fan base. Okay, cool, do both. Now, AI camera, all in video. The answer is to do everything. It's not one or another. Michael Saylor had a traditional technology company and then went heavily into Bitcoin while still having a technology company. Apple did not invest into AI. Mistake. You know how much it pains me to openly criticize the company that I love the most publicly? Failing. The answer is to do both. Always.
Yeah. Yep. I think at this
trade or invest, both.
At this point in time, you can't just only invest in index funds because you are going to miss tremendous opportunities from individual stocks.
Absolutely.
But also, you just got to be careful because you could even pick an individual stock and you have all the faith in it in the world and put all your money in, and then that's risky. Yeah. So do both, ladies and gentlemen. You might not get 20,000% rate of return, but you also can't be greedy either. Never underestimate 20%, 30%. They add up over the course of time.
And the most important thing is length of time to hold. Like the two factors, the mitigation of risk, and I'll be talking about this at my performance at InvestFest. Thank y'all for the time allotted. Ooh, gonna be a movie. Mitigation of risk. So what competitive threats are there to the company that I love the most is one of my favorite prompts. And if you do that at Apple, it looked like World War III. every AI company is aiming at Apple. And then length of time to hold. I always say follow the best hedge funds, countries, and investors on the planet. Dr. Bust didn't sell the Lakers after 10 years. Some of you said 40 years is too long to hold. 10 isn't. If you hold for a 10-year period, you should minimum have 500% return in the technology stock, but probably 2,000 to 4,000 if it's top tier.